Good afternoon, everyone. Good morning, everyone. Good day, everyone. I hope you had a good holidays. If you can hear me, type it in the chat box. And also, if you have ability to download the Speak Up app, I have entered key 96879 as a key which you can actually use to have a direct chat with me. That would be wonderful. Then I can actually answer a question. So here's the agenda for today, including that key that is now being covered up. I'm going to go over the big picture, and that will include looking at the monthly chart on the Dow Jones Industrial Average ETF, on a NASDAQ ETF, on a SPY ETF, and a Russell 2000. Then I'm going to move to the sector analysis, and I'm going to select a trade on one of the sectors, and then I'm going to go ahead and place that trade for the next January, and it's going to be an option trade in which I'm going to use the credit to pay for a debit. Specifically, I'm going to use a bear call spread to finance the bear put spread. So let's pull up the platform here and look at a bigger picture on a monthly. So we're gonna start looking at the Dow Jones Industrial Average ETF, and every one of these charts is actually a monthly chart. As you can see over here, it says monthly. And what is very interesting here that we had a very strong October, strong November, and now we are being encapsulated within price action of the November for this particular month. So the Dow Jones honestly does not look that bad in terms of where it opened in January of this year. So it rallied, came very close. So Dow picture, it's looking good. That doesn't mean it's the same thing for everything else. So each of these 12 bars starting from January is showing that we went down, and then that downtrend, and I'm going to just quickly change color to red here, was broken to the upside in October, in a month when everybody was saying that October is the worst possible month, we're bound to go lower. We actually ripped to the upside. And on the Dow Jones, in terms of where we open and where we are now, really the distance is not that great in terms of how much value the Dow Jones has lost. Now, keep in mind the Dow Jones, it's only 30 stocks, and that doesn't represent entire society of the United States. So the better view of what the market is doing is actually looking at Russell 2000. And the Russell 2000 situation is quite different, because if I'm focusing right now again on the same concept of the beginning of the year, and I'm going to use the yellow here just to make sure that we are all on the same page. So this is again the monthly here, and from where we were and where we are right now, obviously we are much lower. Another thing that it can probably poke your eyes here when you look at it, what is happening with the price action of the December. We are virtually negating entire move of the November to the upside on the Russell 2000, which represents the small caps. So where are we really? Well, we can't make that decision completely till we look at the mother of all products, which is S&P 500, which is represented with the SPY. And SPY, as you can see, has started at this particular level in January, and since then it has gone lower. But when you're comparing just month to month, December to November, we have not dropped as much on Russell 2000, because we haven't taken out the low from November. We're still encapsulated within the body of that November bar, but we are definitely not as strong as the Dow Jones Industrial Average, nor are we as weak as the as the Russell. Now, when you look at the last one, and this is now shifting us towards away from a big picture, more into the sector analysis, because the Nasdaq is one of the sectors, and that's what we're gonna jump in next. You would see on a Nasdaq the situation is completely different from where we started at the beginning of the year versus from where we are. The things are quite significantly different, right? So you're obviously looking here that uh, price action of the November that was up has been significantly negated, and we are really hanging out at the lows of, this is December, this is November, this is October. We're hanging out at the lows of the September, and where we're going to close on the next four session, it remains to be seen. But obviously there is a weakness, and that's why I'm considering placing a bearish bet. So just for a big picture, what is currently taking place today on a big market? So we have gapped up a little bit higher on the Dow, and we came down through the open. We went into the negative territory, and then there was a push to the upside. Now, what is interesting on the Nasdaq, this dotted line represents the previous session close before the holidays. We have gapped down, we rallied up, but we weren't able even to take out the open and move higher. So I'm going to use a blue line here just to kind of mark the open in relation to where's the current price. So this is where we open, and obviously Nasdaq is so weak it could not even go higher than open, which is not the case of the Dow. So what I have shown you on a monthly picture, it still holds same truth on the 10-minute bars. And how do we know it's a 10-minute bars? Because when you're looking right here, in between the 10 and the 9:30, how many bars we have? We have a 3 bars, and each bar represents the 10 minutes. So be aware of it that the S&P is doing something in between what the Dow Jones Industrial Average is doing and what the Nasdaq is doing. So obviously Nasdaq is weak on the 10-minute bars today, as well as on a monthly picture that I'm showing you here. So what I would like to do next is I would like to switch to sectors, and sectors are the ones that are tracked by the majority of the hedge fund and institutions in order to figure out what is truly taking place. Now, there are multiple sectors here that we can discuss, but the sectors that I suggest that we look at are just the sectors that are most weighted in the terms of the importance. So the first of those sectors is the financials, and that ties up nicely hand in hand with what I was talking to you about the big picture on a monthly. When I looked at the Dow, the Russell, which was represented by IWM, the mother of all products, the S&P, and the Nasdaq. So now I'm looking specifically at the XLK. K means tech. There's that K sound in a tech, right? So on the daily, we are definitely very, very weak. We have a lot of red unfilled orders above us, but because this is a sector that everybody looks at, I would like to place this trade not on the technology sector that everybody looks at, but on the financials. But before I get to financials, let's just analyze for a moment what is the sector that tracks the healthcare doing. Now, the sector that tracks the healthcare has a multiple red unfilled order above its current price, and of course, it has a multiple unfilled order below. So I don't necessarily feel that there is a one good trade on the technology, right? I can again bringing the bigger picture here on FinViz just to show you how the healthcare is looking. So it's somewhat in an uptrend with the huge drop to the downside. But I feel that XLF, which is the product that I was preparing myself for today to place a trade on, looks way healthier to the upside now. It still have a pullback, but there is a high chance that if something happens, it could be even lower. So we're not late comers on the financials in terms of the entry as we would have been if we have jumped in, for instance, into the technology or the healthcare. So what I want to point out to you here that I definitely see at this particular level 36 as a possible level of resistance, which would be right above these red UFOs that are between the 3450 and highs at 3593. And then I'm also looking here to the downside at perhaps 32. Now, again, all my planning is out of the window if, and I emphasize, if and only if nobody else is considering placing that trade. So what we're gonna do right now, we're gonna now look at financing the 39 put by placing the trade on XLF that is gonna involve the 36 call being sold and a 37 put being bought. So one more time, I'm gonna now emphasize here what I have in mind. So I'm considering placing the bearish trade on an XLF and an XLF, which is going to involve, and I'm going to just create a table here to kind of make the things simple. The bear call on the side with strike prices that are going to be buying to open 37, and then on the downside I'm going to be selling to open 36, and of course these are the calls. So when you look at one more time picture, that would be above and beyond this red unfilled order if we were right in this area around the 36, right? So we're gonna do that simply by pulling up the option chain, and we're gonna look at for a January, for a regular January, what is the activity for that particular spread that I want to do. So I'm doing the bear call spread for a January of the next year that is going to be involved buying the higher strike price, which is 37, and selling the lower strike price, which is 36 call. So when I click this, it's showing to me that I could get 10 cents, right? But the 10 cents on the $1, that's a 10% return. Now, what I'm going to do now is pull up the Thinkorswim platform, which is already open for a January, and I'm going to just show you the volume of those particular contracts that I'm considering. So the volume for the open interest for the January of the next year in a ETF that tracks the financials that is currently slightly up about 8 cents, it's up, is following. And this really, I believe, is going to be poking your eyes. 44,748 contracts have been traded for a 14 cents on a bid, because we're going to be a seller and we always sell at the bid. But we'll need to return a little bit of that because we're going to be buying this one at 37 that even has a greater activity. The activity in terms of the open interest is a 51,583 of the open interest. So we're supposed to get here about 10 cents of the premium, which I'm going to use to finance, and let me change the color here to red, this 32 put. And this 32 put cost me 20 cents. As you can see over here, it's about 20 cents. 20 to 21 cents. So I would need to sell two of these to pay for my 32 put that has a crazy amount of activity of 138. Now, of course, I want to make sure that my technical analysis matches what my chart uh, is pointing out to me. So let me just now float this for a second, and I'm going to move it out of the way and show you one more time on the chart. So you would be aware of it, that what we are doing here on XLF is sound from the technical point of view. So at this top level right here, we are doing the bear call spread that involves a 36 strike price that is being sold and a 37 strike price that is being bought for a credit of the 10 cents. That 10 cents credit we're going to utilize to go ahead and purchase down here the long 32 put that is currently trading for about 20 cents. So we would need two of the 36, 37 bear calls to pay for 132 put. So let's now go again and create this and then fire the trade in. So for us to create this, I'm going to go back again on the option chain. I'm going to have here the bear call spread one more time, built from the uh, from the ground up, so there will be no confusion how we did that. So we're doing the January on both of these. We're buying the 37 in order for us to sell the 36. And that 36, when I click here, OK, and I show you the added spread, it shows me the 10 cents. Now I'm going to make this into two contracts. And of course, when I make it into two contracts, that's going to be the cost of the 20. So let me just take a snapshot of this bear call spread that I'm doing. This bear call spread that I'm doing, and make sure that there's no there. So this is supposed to say bear call spread. Bear call spread. Selling the 36, buying the 37 twice. So there it is. There's that 20 cents of the value. So I'm taking that right here, and what I'm going to do for simplicity's sake, I'm going to put it right above here because that price is above my current price. So the current price of the XLF is now 34 even. So if you know that we are here at the 34 even, so I'm going to just have here one more line. XLF, let's make this an uppercase. XLF is sitting at 34 even currently. So we have a cushion of about $2 protection if this price goes up. And what do we want to do with that? We want to use that 20 cents that we received in order to buy BTO, buy to open the 32 call. Now, reason why I'm not putting any expiration here, because everything is done for January of the 2023 on a monthly. So let's go fire the trade in. And when we fire the trade in, I'm going to pull up one of the cards, sticky notes, and I'm going to have that. So just before we do that, I want to point out here that I don't have any open position. Profit and losses are $1,095. I have about $10,000 in, so I'm good to trade. And once when I place that trade, you would see that they're going to take a $20 out of me. So $20, $21 is going to be taken out of me plus the 65 cents of the commission. So I'm sending that in. Now I'm filled and it says position. You have a one contract open. I can go over here and just kind of click here and show that we have a one position of one contract. So here it is. So here's my one contract, and open position in green means that I bought it, and that is my put at 32. Now I have now invested the $20, $21 plus change, and that shows that my buying power effect has decreased in amount of $20 due to the fact that I have gone ahead and placed that trade. So there's the $21 plus 65 cents that I have paid for commission, and I really want to finance that. And how do we finance that? We actually go ahead and place the trade here. 36 is what is being sold, and 37 is what is being bought. And we said going down is going to make the two contracts rather than one contract. And I'm now asking 10, and when I click it here, it's going to multiply, so it's going to give me the 20. Now, of course, there is a maximum loss, and I'm going to come back to that and explain it. So now see here if I'm going to get filled on that. It's a working order for 10 cents. They're not giving it to me. Let me just drop it down to 9 cents. Most likely they're going to fill me instantly on a 9 cents. There it is. It got filled for a 9 cents. So let me just see here if you have any comments in the chat room. No, all is good. So we got my carry out. So over here, my buying power went $200. So let me now bring in again our platform here and explain what happened here. So this particular trade, when I click on risk graph, it points out to us that we have only a little sliver here of the 10 cents as a profit, but our potential loss is a much greater than that. In fact, I'm going to just take a snap of this. So I would have that inside the Word document here that I have created at the beginning of the session to kind of walk you through this whole trade. So here's a total risk on a trade. Total risk on this particular trade, and I'm going to switch this in red so it will be more obvious, is $180. So it's not even $200. Why it's not $200? Because they have given me $20. In my case, they have me $18 because I have dropped it by a penny. So just be aware of it. That's what the current situation is in terms of my risk on a capital. So we're going to talk about the best possible outcome in a moment, because I want to make sure that I actually explain the sticky notes here of the cards that we are doing. So this is just an example of the stock trade. So if I have a stock trade on XLF, let me make sure that I have this typed in properly in uppercase. So here it is. It's XLF. And I'm doing that trade for January of the next year, because I want to be out of that trade by the expiration, which is the third Friday. Direction is not long, but it's short. And we have entered when we are at 34. Our stop loss, I'm going to just bring in quickly the chart one more time so you would see it on the chart. And I'm using the FinViz here just because I want you to be aware of it, what the big market is doing at the same time as I'm doing this. So 36 is where my bear call spread is. Up here is about the 35.25. That's where I'm going to put my stop loss, just in case I'm wrong. So on my sticky notes, I'm going to mark that as that. And let me just make sure that I also have that on my Thinkorswim platform here when I go ahead and have this here. So I'm going to close my spread if the price action is going at or above, and I need to make sure that I talk to you through this whole thing, because it's very important that you understand that this particular thing that I'm doing has a condition that is going to go to the, just 1 second here, I need to drag it in, this confirmation at so when the price action is on an XLF at or X method mark, when we are above 35.25, that's what I want to get out of my spread, because really majority of my money is actually invested inside of that spread, not necessarily inside of that $20 thing. So let me now just walk you slowly through it. This line right here is where my stop is. This is a 35.25 is where my stop is. So let's make sure that I capture this over here. And we really don't know what the price is going to be market wise when this thing takes place. So we are building this in such a way that we have a stop at the 35.25 at the option premium market order, whatever that thing is. So I'm going to get out here. So close me out to market. If the XLF rips to the upside, then I really don't want to trade that anymore. And on a day like today, we had a move in the morning to the downside. We had the moving at the reversal time, which is 10 o'clock New York, to the upside. And what is going to be now that we are going in a lunch hour, it remains to be seen, but I wouldn't be surprised with internals that are so mixed. Like a Christmas colors, you have like red, you have some black, you have some green. I don't expect much of anything, but even possibly maybe drop to the downside. So knowing that we have the stop place, I also need to make sure that I place my stop on a put that I bought for 20 cents at the same level. So I want to just make sure that you guys are following. So this order that now it's marking waiting condition is only the order for a credit spread, but it's not the order for my single leg option. My single leg option is one that I need to make sure that I have ready to go. So same condition, create the opposite order. When the price action is at or above 35.25, then I can say that I need to act. The target, I'm gonna talk in a few seconds here, but I want to make sure that everybody understands that 35.25 would mean if it's reached, that I'm on the wrong side of the trade. I expect this to go lower, and if it doesn't go lower, then I'm gonna get out. So one more time, same concept I'm gonna have here. Order condition, mark like here, pointing is that this is at the market order. Gonna take a snapshot and keep it in a Word document here, so it's more clear what we did. So this is for a spread. This is for a spread, and this is for this call side. We bought this call at the price of the 21 cents debit, and we sold two of these. And I think the price was 18 cents because we had 9 cents times 2. So we were slightly in a hole, but now we gonna fill in the card for a credit spread here to make sure that we understand for a credit spread how this whole thing works. So just one second, I'm gonna grab from the other screen here that I have open. The credit spread, same thing. We have a XLF. Make sure that that's in uppercase, XLF. So that's financial. We're trading this for January of the next year, which is 23. The earnings on that are not really part of the picture because XLF is nothing else but the ETF. So ETFs don't have earnings, so you don't need to worry about it. Otherwise, earnings on the regular stock would matter. So this thing here that I wrote. I should just put not available because on the ETFs that's not an issue. So we're doing the January. It takes some time to fill this thing up, and this is a 23. And we're doing the call side. So the higher strike price was my long 37 call. My short strike price was 36 call. So this 36 call that I have here is what I sold. And we already pointed out to you that we have placed the exit at 32.25, and we don't have any activation rule because we are already in it. So the sticky note is done. Now let's entertain the possibility by looking at the chart what is going to happen at the exit. And again, I'm using now the same concept that I have here in terms of the pictures. So in terms of the picture, this is my long call. So we have a long $32 call. And we're going to discuss if the January 23rd comes, what is going to happen to our price with that 32 put versus the bear call spread that has involved selling the 36 and buying the 37. So that's what we are doing. So let's now revisit the chart one more time. I'm going to send this and make sure that you understand. On both of these things, I have only placed the stops, not the target, because I want to first discuss the target with you before we move on. No questions so far? Just look it over here. No, we're good to go. So I'm going to just continue by looking at the chart. So if the price action on XLF goes through the 32 and continue going lower and it hits 30, because over here, as you can see, at the 29.37, there's another zone. But if all of a sudden we have a recession, whatever negative you want to put in, and the price action drops significantly lower to 32, could we now figure out what is going to happen on the third Friday of that month? So what I'm going to do right now, I'm going to now assume that it's January 3rd Friday of the next year, and the price action is at 30. So XLF has dropped down to 30. And I'm going to just make this into, let's say, red color because it dropped. My bear call spread at that point expires worthless. So that means that $180 that is being currently held as my maintenance or a margin is going to get freed the day after the expiration. That means the next Monday is going to get freed. But then what is going to happen with my $32? Look, I misspelled it here. I was supposed to say put because we bought the put. We're financing the put with the bear call. The 32 put is going to be in the money exactly $2. How do we know that? Well, the put gives me the right to sell at the higher price, and now that is at 30, I'm covering at the lower price. That means I have $2 of the value that in reality I paid only 21 cents. So what did I actually end up making? I made the $1.17 or $179 on it. So are you getting this? This is like almost like a 100% trade, because we have been placing this trade with $180 and we are earning here after the commission still about $180. So this is the whole concept of the trading the long puts by financing than with short verticals. And in this case, this short vertical is namely bear call spread. So what I like to do, I like to go through this process again and again and again. But because I have started with the sectors, I think makes sense that I move on to the next sector, which is the technology. So when you're looking right here, the XLC is a technology sector that we can look at, and it has a lot of red UFO. So definitely we're considering this to be a bearish bet to the downside, but all of my thoughts go out of the window if I pull up the option chain and I do not find any of the activities in terms of the open interest or any of it on the downside. So what I'm doing right now, I'm going to actually add a study that is going to help us with that, and that is option value map. An option value map can be altered and can be used at different levels. But what I want you to take a look over here, I have here a huge activity for a February, exactly here at 50. And 50 is definitely way higher than the current price of the 47. So there has been a huge activity right there on the 50. Okay, so let's now bring this up for a February. XLC is a ticker. We're going to open up the February. I'm going to type in the ticker XLC, and we're going to look at the activity in terms of the 141 contracts and something that is not very liquid was traded here for $1. So if I'm going to place this trade, I'm going to repeat the same steps that I did earlier. So just like over here, I have a bear call spread versus a long put. I'm doing the same thing now, but it's not going to be for a February. It's not going to be now we're looking at the XLC trade. This XLC trade is going to be for a February. No questions so far? Let me just see here online. Anybody interacting with me? Nope. So I interpret your silence as a sign that I can proceed and carry on. So 50 is where we have discovered the huge activity, but we would need to protect ourselves with the 51. So if I now speed up my execution, so I'm going to take $1 and return them some money, because if I'm selling the 50, I need to protect myself with 51. I'm returning them 75 cents, but I'm still taking 25 cents. So now I got filled for 25 cents, but my maintenance is a 75 cents or $75 on it, right? So if you're looking right here, now it shows that I have two open positions. I have an open position on XLF that we already discussed, and I have a buying power effect of the $100, but out of that $100, they have given me, and I'm circling this so it can be more obvious for you, $25. So really, for all the practical purposes, over here, it's supposed to be only $75 less of my value. So in case you're losing what I'm trying to say, I'm going to show you here on a cash tracking. So at 8:38, I have paid the commission 65 cents twice, which is $1.35, plus the exchange fees in amount of 3 cents. But I have paid that from the profit of over here $25 that was given to me. Because if you're looking right here, my buying power was at $10,771, and it has gone up in amount of about $24 and whatever that change is, right? To the 10,795. At the expense of me, you are now obliged until what day? The February 17th, to hold on to that contract unless you put what we put on another which is called a stop loss. But be aware of it. This is just a one leg of my trade, and I like to start first with financing before I move on with anything else. How do we find out that trade? We found out that trade by inserting the option value map. How do we insert the option value map? We went over here, we click the add study, and there's only two patented things at the top. Redactive option planner, right? There's of course auto UFOs that are being displayed right here, as you can already see. And a second one is the option value map. And I like to use the option value map because actually it helps me. But what you can do with that, if you double click on it, it changes to open interest. So when you change on open interest, you would see there's a lot more activity on open interest, but I use the volume because somebody has already traded that today, and all you need to do is just keep on clicking on that. The more you click, the more you're gonna get information about the specific things. So first time when you click on it, you get the strike price, then you get the open interest, and then you get the premium of it, right? How do you remove it? You simply go over here where it says remove study. Make sure you don't click on auto UFO because that's gonna remove this unfilled order. You just remove the option value map. So we know that the 50 level here is what we sold, right? So we're now looking, where can this possibly go? And really, I mean, we need to bring a more picture in to see where we are going. Let me just double check quickly here on the FinViz what the market is doing, because in the morning market was fast moving. Within the first 10 minutes it went lower. Second 10 minutes went lower, third 10 minutes went lower, then it stopped going lower, and then one 10-minute bar has negated that half an hour move down. So right now, I guess going into the lunchtime, Nasdaq is not doing anything, S&P is not doing anything. The strongest one is Dow, and it's trying to rip to the upside. So let's find a target on my XLC. On an XLC, if we are going down, which obviously you can see it here that we're going down, most likely we're going to go down to 45. So let's now consider buying the 45 with the 25 cents that we have received. So we have received 25 cents. And we'll now clean this up so it can be easier for you to understand what really happened here. So I have here two orders, right? Two orders that are in red. It shows that I have sent in at 8:38 and 44 seconds my order, and it got filled 2 seconds later at 3:38:46. So it took 2 seconds from the moment I click on my end till the other end to get filled. So now that I have it at 25 cents, I want to buy the 45, but that 45 is going to cost me more. So now when I'm looking at the open interest, there are traders who are even considering that it can go as low as, and let me now point out the 44 here, as 44, because when you look at here, no digits, because that's a zero. Then you have a two digits, 72 for this strike price of the 42, but we didn't check that on a chart. We check actually 45. But now that I'm looking that the big institutions are considering that this is going down to 44, most likely I would like to get 44. Now, if I've gotten only 25 cents and this costs me 80 cents, I would need to add maybe 3 more in order to completely finance that. So let me now just kind of recap this. So my 44 put is at ask 80 cents. This one, I have gotten the credit of the 25. So if I would just multiply this by 4, okay, so that would give me enough to completely have this free, So how do we do this at the same time? Well, let me now go over here, option chain, change this to XLC, and we're talking about the bear call spread that we just placed, and this bear call spread was for a February. changes in both of them. It involved buying of the 51, and it involved also selling of the 50. So now when I click on it, there's that 26 cents. Now I'm going to edit that in such a way that I'm going to add this to be 4. So when I add this to be 4 and I get amount of the $110, I can now add here one more option leg. This option leg, it's also a purchase, but it's not purchased by 4 times. It's purchased by the one time, and it's not a call, but it's a put. And we said we want to do the 44 put. And the reason why we like to do 44 put, no questions yet? Okay, good. 44 put is for a simple reason that we are paying 80 cents, but over here we are receiving over $1. So now when I click this, I'm actually having the good outcome here. I'm actually even receiving the more money. So let me now make this more real. I'm gonna make this more real. So you see this 44, it's going for 80 cents. I'm now buying it for 80 cents. Just sip the water. I got price improvement. I got filled at 75. Isn't that nice? I was willing to pay. I was willing to pay 80. But now that they gave me 75, I'm going to alter what I have planned this in my top. I'm going to alter it by simply changing this to the 3 contracts. So I'm going to say I don't need 4. I only need the 3 to pay for that. So I will just pull up the information here of how much am I getting this on each leg, so it's not that confusing later on when you review this session. So I'm gonna put this in the Word document here, and we're gonna discuss the exits in the next 10 minutes. But I want to make sure that I have this information pull up here at the side. So when I go ahead and fill up this information over here, for a 50, my filled price was $1.10. For a 51, I had to return them some money, and I had returned them 85 cents. Now, obviously, visually, you can see when you subtract the 85 from $1.10, that's about that 25. And then you need to multiply that by this by 3, but let the computer do that work. While over here, I actually went ahead and I purchased it for 75. So everything that I got from here, from this section right here. If you can just see how I have got that. 75 is for my long put. $1.10 is for my short $50 call that was sold. And then, of course, out of the $1.10, I had to return them 85 cents because when you sell a call, you need to have a protection. My protection is at 51. So now when I click here, OK, see, it calculates it. So now what I can do over here, I'm going to risk graph this. So you would even have a ability to see how this thing looks on it. OK, having said that, let's now conclude by adding 2 more. Why do I need to add the 2 more? Because right now I'm in a hole. So watch here. My buying power effect is only $100, but I only got 25 cents for that XLF. Correct? Let me just keep here on XLC. So I don't mix up the XLF with XLC. One is the financials. C stands for communication. So I would need to add 2 more of these. So I'm going to go over here where it says create duplicate. You're always going down rather than going up because this is now on the negative side. So now it's going to say you're going to get the 2 times 25 cents, which equals 50 cents. Out of the $200 that you need to pay us, we, market maker, the broker, whoever, we only need 150 because 150 plus 50 is the 200. So I'm sending this in, and I'm supposed to hear ding any second here. There it is, sold. So now you will see that I have got filled at the 8:50, 10 minutes before the session is over, twice. So what do you think my maintenance is going to be now? 300. So this morning I have risked about $500 out of the account that had about the $10,000 of the buying power. So this is very conservative way of trading, and if everything works out, we're gonna entertain what is gonna be now to exit. So let's now talk about the exit. If now is exit, and we are now February 3rd Friday, and let's now entertain this one more time. I have a 44 put, and let's just assume that on that day, XLC has dropped significantly and it's at $40. So if this XLC on that day is at $40, and let's make this again in red because I want to be consistent. How much is my 44 put in the money? At that point, it's going to be in the money by exactly $4. How much did I pay for it? 80 cents. What is it that I ended up making? $360. How much of the maintenance we were talking about that I had on? I had about $300 of the maintenance minus the 25 cents, minus the 25 cents, minus the 25 cents, which means 75 cents, right? So we had like a trade that was risking $225 and it earned us 360 if the price goes to 40 in 2 months. In 2 months. Now again, whether or not that's going to happen, it remains to be seen. So let's now recap everything that we have done ever since we started this session about an hour ago. I have provided you the code. You've been interacting here with me. I looked at the big picture. I summarized pretty much what is taking place, and obviously the weakest of the four big ones, the Dow, the S&P, the Nasdaq, and the Russell, was the Nasdaq. And on Nasdaq, we chose not to trade the technology, but we chose to trade communication because if something goes bad, maybe people are gonna stop paying for their cell phones or for whatever, and that's gonna then affect the whole communication sector and might go down. On XLF, we have placed the trade and we spend the majority of the time explaining that we were actually financing our long puts with the short verticals. So these short verticals were financing these long puts. And then we repeated the same thing on this last one now. On this last one, how do we find a trade? Well, we found the trade in such a way that we simply have inserted inside of our daily chart, on the Productive Option Planner, a proprietary tool called Option Value Map. And we can change whether or not we want to look at the contract or we want to look at the open interest or whether we want to look at premium or whatnot. So when you click here, okay, you actually ended up getting just apply this, not okay, but apply this. You are getting a line that is in blue and a line that is in red. So blue line represents the calls, the red line represents the put if you're on a volume. But if you're on an open interest, then the calls are going to be in the green and put are going to be in magenta. So just be aware of it. So I have already applied it. So now I can show you when I click over here, and now we get to the puts. You see how the colors change? The colors change. So let's look at over here. On January, there's more puts being traded than calls, right? But we didn't trade that for a January. We actually traded that for a what? For a February, because this huge activity is what was poking our eyes. Now, could you do that for any single product? Yeah, I mean, here we can type in Tesla just to kind of show you what's going on with Tesla because they're just killing it. They, meaning the institutions, are killing it. Okay, so there it is. So you're looking right here on a Tesla, you have a lot of calls that are being sold, and these calls that are being sold at this 130 level are actually paying most likely for this put that is at the 110. So this is really what is happening behind the scene. But we're gonna just stick to what we have done. We have done the XLC. The reason why I picked the February over the January is because there was simply more activity for it. Simply more for it. How do we remove this thing? We just go over here and we remove it. So one more time, which market is the strongest as of this morning? As of this morning, the market is the strongest is Dow Jones, and we know the Dow Jones is not only strong today, but it's been strong also on a monthly. Because when we started looking at the big picture, we concluded that on a monthly, the Dow has been up. So here's a picture of the Dow, and when you switch here on a monthly, you see that big picture, like this is the way how it has gone down. And I've shown you all this on Trade Active. So one more time, I want to wish you a happy new year and all the best, and thank you for interacting with me, and see you next year. Stay hedged. Bye.